I fixed 47 QuickBooks files this year, and here are the top 3 disasters and red flags you can spot today. Last year alone, I fixed 47 QuickBooks disasters. Some took 20 minutes, others took 3 days, and still others months. The worst one was a construction company that thought they made $50,000 in profit, but they actually lost $30,000. By the end of this video, you'll know the 3 disasters I see most and how to spot them before they destroy your business. But before we dive in, let me give you some context on just how common these problems are. Of those 47 files I fixed, 43 had at least one of the 3 disasters I'm about to show you. That's 91%. And here's the scary part. Most of these business owners had no idea they had problems until they needed accurate financial information for a loan, a tax audit, or a business sale. I'm going to be brutally honest in this video because I want you to understand the real cost of these mistakes. These aren't just bookkeeping errors. They're business-killing problems that can cost you tens of thousands of dollars. I'm Bev from bookkeepingcoach.net. The reason I can help these businesses is because I've seen every possible way QuickBooks can go wrong. I've been doing this for over 30 years, and I've developed systems for quickly identifying and fixing the most common disasters. Today, I'm going to share the top 3 with you. Disaster number 1 is the everything is office supplies problem. I call the everything bucket disaster number 1. Last month, I reviewed the books for a consulting firm, and their office supplies account showed $42,000 for the year. Unless you're running Staples, that's wrong. Dead wrong. Here's what I found when I dug into that account. Actual office supplies like pens, paper, and printer ink was $1,200. A new computer system, $3,500. Marketing materials and brochures, $8,000. Restaurant meals with clients, $4,500. Vehicle maintenance for the company car, $2,800, and somehow a $15,000 piece of specialized equipment. This happens because office supplies feels safe. It's clearly a business expense, right? So when people don't know where something goes, or when they're in a hurry, or when QuickBooks suggests office supplies as a category, boom, that's where it goes. But here's the problem. Not all business expenses are created equal. That computer should be depreciated over several years, not expensed immediately. Those marketing materials should be tracked separately so you can measure your marketing ROI. Those client meals have specific tax rules, and that equipment affects your business loan applications and your insurance coverage. This mistake happens for 3 main reasons. First, fear. People are afraid of creating new accounts or choosing the wrong category, so they pick something that feels safe. Office supplies sounds like a reasonable place for any business purchase. Second is speed. When you're trying to catch up on your bookkeeping and you have 200 or more transactions to categorize, you start taking shortcuts. Close enough becomes good enough. And office supplies becomes the default for anything you can't quickly categorize. Third is a lack of understanding about how categories affect your business. Most people think categorization is just for organization. They don't realize that where you categorize expenses affects your taxes, your loan applications, your insurance claims, and your ability to understand your business performance. When everything gets dumped into office supplies, you really have no idea what you're actually spending money on. This client had no idea they were spending $8,000 a year on marketing because it was all mixed in with the actual office supplies. They couldn't tell if their marketing was working because they couldn't track the investment. Red flag check. If your office supplies account or any expense account is more than 2% of your total expenses, you've probably got this problem. The quick fix, sort your office supplies account by amount, largest first, and recategorize anything that needs to be into the correct account. Number 2 disaster is bank feed chaos and duplicate transactions. This is probably the most common disaster I see, and it's the one that creates the most work to fix. Last month, I worked on a retail client's books that had 847 uncategorized transactions, more than 200 duplicates, and bank rules that were fighting each other. Here's how this happens. Someone sets up QuickBooks, connects their bank account, and thinks they're done. They start categorizing transactions as they come in, but they don't understand how bank feeds actually work. They don't set up rules properly. They don't understand the difference between automatic and manual entry. And they definitely don't understand how to handle exceptions. Here's what I found in this retail client's books. The same payment to their main supplier was recorded 5 different ways. Once from the bank feed, once manually entered, once from a recurring transaction, once from paying a bill, and once as a general journal entry. A cash deposit was recorded as income and as the owner contribution. Credit card payments were recorded as expenses instead of transfers to pay down the credit card balance. When bank feeds are wrong, everything downstream becomes wrong. Your profit and loss report is wrong, so you don't know if you're actually making any money. Your cash flow reports are wrong, so you can't predict when you'll have cash shortages. Your tax categories are wrong, so your tax preparation takes longer and costs more. The retail client thought they had their best month ever in October, $15,000 more revenue than any previous month. They were planning to hire additional staff and lease a bigger space. It turns out 12,000 of that revenue was duplicate transactions from their payment processor. Their actual October was only slightly better than their average month. The red flag check for bank feed chaos: if you have more than 50 uncategorized transactions, you're in crisis mode. More than 10 duplicates means your numbers are definitely wrong. And if you can't remember the last time you reconciled your bank accounts, credit cards, and liability accounts, you're in serious trouble. If you're in crisis mode, here's your emergency triage. First, stop everything. Don't categorize any more transactions until you understand what you're doing wrong. Second, identify and delete obvious duplicates, but be careful because some transactions that look like duplicates aren't. Third, focus on the biggest transactions first because they have the biggest impact on your numbers. Prevention is about setting up bank rules properly from day one. One rule per vendor, clear and specific. Don't create rules that are too broad because they'll catch transactions you don't want them to. And check your feeds weekly, not monthly. It's much easier to catch and fix your mistakes when they're fresh. Disaster number 3, inventory tracking nightmares. Disaster number 3, inventory hell. This retail client had thought they had 25,000 in inventory sitting on their shelves. When we did an actual physical count, they had 8,000. They'd been making purchasing decisions based on wrong data for 18 months, and it nearly bankrupted them. Inventory tracking fails in QuickBooks because people don't understand how it works. They think they can just turn on inventory tracking and everything will magically work. But inventory tracking requires you to record every purchase, every sale, every adjustment, and every loss correctly. Miss any piece of that puzzle, and your numbers become meaningless. Inventory tracking is the most complex thing you can do in QuickBooks, and most people underestimate how much work it requires. You need to set up your products correctly with accurate costs and quantities. You need to record purchases correctly, making sure they go to inventory accounts, not expense accounts. You need to record sales correctly, making sure they reduce inventory quantities and calculate your cost of goods sold. This isn't just about bookkeeping accuracy. This client ordered $15,000 of inventory they didn't need because their report said they were low on stock. Meanwhile, they were sitting on $17,000 of dead stock that wasn't even recorded in their system because they'd written it off incorrect. The cash flow impact was devastating. They had $32,000 tied up in inventory they couldn't sell, but their reports showed they only had $25,000 in inventory. They thought they had more cash available than they actually did, so they took on additional expenses that they just couldn't afford. When they applied for a business loan, the bank required audited financial statements. The auditor found the inventory discrepancies and required a complete restatement of their financial reports. This delayed their loan approval by 4 months and ultimately resulted in a higher interest rate because the bank lost confidence in their financial reporting. Okay, let's do a comprehensive health check on your QuickBooks. I want you to check these red flags right now while you're watching this video. Red flag number 1. Is any single expense account more than 15% of your total expenses? If yes, you probably have the everything bucket problem. Red flag number 2. Do you have more than 20 uncategorized transactions from last month? If yes, your bank feeds are out of control. Red flag number 3. When you run an inventory report, does it match what you actually have within 10%? If no, your inventory tracking is broken. Red flag number 4. Are your biggest customers showing up as vendors or vice versa? This means your setup is fundamentally wrong. Red flag number 5. Does your checking account balance in QuickBooks match your actual bank balance? If not, you've got reconciliation problems. Count your red flags. 0 to 1, you're in good shape, but stay vigilant. 2 to 3, you've got problems that need attention soon. 4 to 5, you are in crisis mode and you need help immediately. If you found 2 or more red flags, you're sitting on a ticking time bomb. The good news, every single one of these disasters is fixable, and I've got solutions for each one. The construction company I mentioned at the beginning, we turned their $30,000 loss into a $15,000 profit just by fixing their categorization and inventory tracking. The retail client reduced their debt inventory by $12,000 and freed up cash flow that let them expand to a second location. Here's how you can fix your red flags. For new bookkeepers and small business owners that are doing their own books, my QBO Mastery course has specific 2 to 5 minute videos for each of these disasters. Watch bank feed cleanup or inventory tracking made simple. Exactly what you need, nothing you don't. For new bookkeepers, these are the exact scenarios we solve in my group coaching for new bookkeepers. Learn how to fix these problems for your clients and build your expertise. For ongoing support, if you're managing your own books and you want backup, my business owner group coaching means you never have to face these disasters alone. We meet bi-weekly. You send me your specific issues ahead of time, and we'll review them on the call. All the links are in the description below. And if you found this helpful, subscribe and hit the bell, because next week, I'm going to be showing you the setup that helps prevent all of these disasters from happening in the first place.